not many. Do you think other YouTubers open up with like a disgusting coffee flavored burp to their videos? Anyways, I'm coughing so much because I'm still fucking sick for some reason. Anyways, let's get to the music. Let's get to the video. All right, everybody. We're going to do a little stock market, little macro update here for you. I've covered the Banking Cabal short before, or what I have dubbed the Banking Cabal short, and I'm going to show you again what that is, because it is certainly, well, not certainly, but I would say with a high probability it is playing out right now. So I'm going to get straight into it. This is the XLF. This is the banking sector of the S&P. So this is quite a few large cap banks, which would include, I believe, American Express, Bank of America. We got BlackRock, Berkshire Hathaway, Fifth Third, Goldman Sachs, JP Morgan, Morgan Stanley, and Visa. So we're looking at all sort of banking sector type things. And if we go to the 4-hour, so here I believe back in March was the Silicon Valley debacle bullshit, and you know, lately we've had more FUD and more FUD about some regional banks and some other smaller banks. Anyways, I kind of figured the FUD would keep going on, and that's why I've been covering this ETF and the financial sector in general, because it's been experiencing a shitload of volatility as of late, and it's provided a great opportunity to short. Excuse me. So let me fix this here. Again, excuse me. I've had a really bad cough and cold lately. I'm just trying to fix my charts here a little bit so it's more clear what's going on. So I was tracking this structure. This I made. If you were on the channel, you would understand that we've been using this ETF FAZ, which is a triple short on the banking sector. Wait, what did I draw there? It's almost what played out. This is a triple short that it has exposure to the banking sector, and I've dubbed it the Banking Cabal short. And why do I say cabal? Well, you've got a group of banks here that essentially get a slap on the wrist every time they fuck up or they get bailed out, you know, by some larger entity or absorbed by some larger entity. For instance, we have, I don't have it up here, but we had UBS recently acquire Credit Suisse, both Swiss banks. That actually has helped stabilize UBS's share price, I believe, because they were able to buy Credit Suisse shares for literally pennies on the dollar. So again, it's 2008 all over again. We have big banks, medium banks, and small banks shitting the bed, and then we have larger companies and or sovereign governments coming in with a slap on the wrist for losing all of your money. You know, again, it's 2023 and they're doing it again. So there's if you're not aware already, there's definitely bank runs of sorts taking place. I'm also a gold and silver bullion dealer, and I can tell you the premiums I'm getting for silver and gold right now are the highest I've ever experienced. Meaning, like, if I were to sell you an ounce of silver, okay, an ounce of silver right now, spot is like $25. But no way in hell you're getting an ounce of silver, physical silver, for less than like 30. Probably more towards like 35 if you were to go to like a retail space. And you'd see the same things with gold. Yeah, so gold's at 2018. Gold is really, really testing this 2000 number, which is extremely interesting to me. This, you know, we'll see if it can hold and get above and create some pattern. Maybe it's gonna do this, consolidate sideways more, and then eventually break out. If gold and silver, well, if gold breaks out of this cup and handle, and I know I'm jumping all over the place, but it's useful to express why this is important. So you have a big old cup and handle here, potentially forming on gold. And, okay, well, why is that happening? Well, part of the reason why, if we go back to the financial sector, is we are losing faith in our banks yet again, like we did in 2007 with the great financial crisis, the housing market crisis, like we did during the pandemic, the scandemic. So faith is being lost in the banking sector. You know, they don't even have to actually hold your money in the bank anyways. Like, I hope that is clear. The fractional reserve banking system dictates that if you go put $100 in the bank, they don't even have to keep like $1 of your money. They're gonna lend it out to someone else, and then what they're gonna do is with that debt, they're gonna then sell your debt to another company, so the bank doesn't even own your debt because they don't have the means to service it at this point. So debt is moving around a whole lot. In general in the banking system, and we're seeing structural weakness in the whole sector, I would say, because if you take a look at the financial sector, it's been very consistently going down, since January of 2022. That was a top. We're down 20% as of now, but if we compare that to something like the transportation index on the Dow, okay, this still isn't so great. Okay, down 22%. I was trying to find something that's a little less risky right now to compare it towards. Let's just look at the S&P. So if you look at the S&P looks a little bit better than the rest of the banking sector. Okay, so down 13% compared to the financial sector, which is down like 20%. Obviously, you can see this has been a bit more of aggressive sell-off, and that's because, you know, people are losing faith in the banking system, which they rightly should. We know last time there was a recession, they got a slap on the wrist. They got bailouts from the government, and it's happening all over again. It's happening with Credit Suisse. It's happening with Silicon Valley Bank. It's going to keep happening, and at some point there is going to be some institution that's quote-unquote too big to fail that's going to shit the bed again, and you're going to see more and more fallout. Well, lately we've had a lot of FUD, just continuing the FUD, but I want to highlight this short that I've been swing trading. And I say swing trading because you don't want to hold this long term. Like, look at this. You don't want to hold it long term. But as a swing trading sort of thing, it is a useful tool. So this tool right here, what I just turned on, is called a quadratic kernel. And it sort of helps you see macro trend changes. We got the daily time frame on. And yeah, we'll keep this on the 1 day so you can see a bit more macro changes. But you can see lately when Silicon Valley Bank shit the bed, we had a bit of an uptick. It hit the outer regression line on this and then sold off. I entered again around here, around 20 bucks, which ended up being a great play. If you had been following this channel, you would know that the banking sector is one of the weakest sectors of the S&P 500. We'll turn this on 4 hours so we even get a better look at this. So you can see these candles are clearly represented by this quadratic kernel pretty well. It kind of shows you these channels. If you know what a Dawn chain channel is, this quadratic kernel calculator is also similar to Dawn chain channels. So we'll draw this, and this was your Silicon Valley Bank. So remember, we're looking at FAZ. This is the short, bear 3x shares on the financial index. Here's Silicon Valley Bank bullshit. But the thing is, okay, this short is reaching its highest prices, its most overbought conditions after the news arrives. So you're not going to make money shorting the market before. You're not going to make money shorting the market if you are chasing after a position. You know what I mean? Like, okay, so the Silicon Valley Bank bullshit was in the news probably over here, and that is what's driving up all the price of this short, is because people are like, oh fuck, it's crashing, it's crashing, it's crashing. Okay, well, cool. Well, say you entered over here because you heard it on the news at 22, and you're like, okay, well, shit's gonna keep crashing, so I bet it'll go maybe back up here to 28. But the problem is you can't chase a position. You really can't chase into something that's bullish. You have to wait until you get a sell-off and then try and enter to something you think could be bullish on a more macro trend. So you never want to chase after a position. You want to snipe a position. You want to wait for the opportune moment for entry. Obviously, back last video, excuse me, sorry guys. Last video I had explained to you guys we were trying to enter down here near 17, 15, or 16, sort of near this area, like below this white line. But now we've taken a bounce off of this trend line. I drew this one last video. I would expect to see something like this in a continuation pattern, because if you can see here, our MACD is curling up. So you see this green line. If we get a cross, which means this green line above the blue, and this starts going up this way, let's make this green so you can see what I'm talking about. If this green line does this, that would mean this blue one would go like this and would be support. If this eventually plays out, and you have a full MACD cross, MACD, oh, by the way, is moving average convergence divergence, you would see the rest of this pattern play out, or something akin to this, and the short continuing upwards while the financial sector sells off. So conversely, that would probably look something like this, back down that way, and then ultimately you would have this sort of head and shoulders with this little slumped shoulder over here, and then maybe you get some more support right here or here, but I wouldn't expect anything too great, and maybe even go down even more. I don't expect this to be over for a long time. So what I'm saying is this FAZ could be a tool you could use multiple times during the market turmoil. Okay, say you entered here, or here, or here. The market is very volatile and it's oscillating a lot. So you want to try and look for opportunities when your MACD is way down here. Obviously this would have been an okay entry. This has been an okay entry. We'll see if this plays out what I've extrapolated here, and our MACD goes back above here. Okay, great. But you don't want to be a buyer up here when it's in the news. You know what I mean? That's when you sell. You have to be contrarian. You have to buy when the news cycles settle down, and you have to sell when the news cycle is hyping up the FUD. Because you have to be contrarian. If CNBC is saying banks are failing, oh my gosh, it's the end of the world, that would mean the price of the short is going to be going up. That's when you make your exit. Okay, you sell when others buy, and you buy when others sell. Okay, look, selling, that's when you buy. Okay, you got to be contrarian. Let's look at this. This is the ratio of the two. So FAZ divided by FAS, that would be the triple short divided by the triple long. And this gives us a good sort of visual representation of where our zones would be for technical support areas of resistance and support. So I'm going to move this out some more so we can see. And if you've been following along with this, please let me know if you have any like ideas or feedback for this, if you want anything else. I've been covering this topic specifically because it's the one thing on my channel that if you had been following from the beginning, you would have had an opportunity to make some trading money on this. Obviously not financial advice. You take the risk upon yourself. You need to do what's right for you. But if we look at the ratio between the two, we are getting the MACD to curl over here, right? So for full confirmation, we need this green line to come up through, break through that blue line, and then continue up this way. And I know I just drew a blue line, but we're gonna have to make it green so this is more clear for you. Okay, so say we get something like that. The ratio between the two, I would expect, again, to do something along the lines of that and then come back down, okay? This is when the FUD in the news cycle is going to be the highest. Banks are failing again, oh shit, oh no. Okay, that's going to drive the share price of the short up, which is a good thing if you entered down here when everyone was selling. Like I always say, you have to be contrarian, okay? Well, what does that mean? It's kind of general knowledge at this point that the banking sector and the financial sector is getting hit continually, on and off again, and we don't know when the final end of it is in sight. And I would say I would posit and I would argue, due to the amount of bad debt in commercial real estate and the fact that everyone's working from home now, means there's going to be bigger flushes. So that's my thesis, or part of my thesis, is that a lot of these banks have shit assets on their balance sheets, like Silicon Valley Bank, like Credit Suisse. They have bullshit assets, or they're just making shit up again, like they did in 2008, and like bankers always fucking do because they're pigs, for the most part. Not all of them. There's a lot of good actors out there, let's be real. There's a lot of people that are just doing their job, even if they work at Fifth Third. You know what I mean? Like you're fucking Nancy working at Bank of America, your little regional Bank of America. She has no idea about any of this probably, and nor does she drive, executive C-suite meetings where they do the bad shit, like introducing central bank digital currencies and surveillance finance and things like that. That's more of like the executive. So, anyways, that's a tangent. Let's kind of look at some of the individual stocks in this sector. This is American Express. You can see they missed earnings by, damn, that's a lot. So that's kind of driving some of the market action, as we can see. 2 bad earnings in a row. Then you have the MACD moving back down. So I would expect this to kind of curl over even more and kind of probably go down here, settle out, then go back up. So yeah, you probably find support right in here. Maybe potentially break through if the news is really bad and go down here. But as you can see, the lows that occurred earlier in October of 2022, we had a huge rise. 38% appreciation in American Express over the course of the last couple months. So I really think that was your little Santa Claus rally. That was your little end of year rally. Earnings are good, yada yada yada. Whatever fundamental thesis you want to talk about. Anyways, these banks have bullshit. Well, American Express, is it a bank? No, it's more credit cards. But these companies have shit assets. Like Bank of America, this one's obviously clearly worse. So if we go back, its Santa Claus rally went up 25%, but now you can see we're below that, and we're closing below this level. So this is pretty dangerous for Bank of America, but really good if you're shorting it, obviously. And that's what I'm saying. Join the team that is going to enjoy the downfall. Join me. Buy assets that have real intrinsic value, like gold and silver, which are making really good looking charts in my opinion. If we can get this to pop out here above 2000, well then we're We have no technical levels. We have no idea where gold could go. I think eventually it'll go up to 3K, but you know, that could take, you know, 7 more years or something, you know, I don't know. But as you can see, okay, there's the, where we go. Here's the dot-com bubble. Okay, here's the great financial crisis, the housing crisis. Where's COVID? COVID is like here. So if we just take it from the dot-com bubble, you know, a lot of people rag on gold, a lot of people love it. Since the dot-com bubble, gold's been up 626%. While the stock market, this is going to be a bigger number, obviously, but you got to realize the stock market goes up this much because they print more money. If we go from the dot-com bubble, stock market's up 181%, S&P. Oh, I thought it was actually going to be more. So clearly, I mean, I feel like that's pretty clear to me. I mean, okay, let's measure them both again from the correct. So this is the peak of the dot-com era to our current levels. That's 177.47% appreciation if you were to buy at the top of the dot-com bubble and still have it from now. That's just like a share of the S&P 500, let's say. If you were to buy an ounce of gold at the peak of the dot-com bubble, we said July 2000 for that. December, November, October, July. About right here. Oh, I'm going to have to move the chart over. Where's July 2000? Sorry. It's going a little bit finicky. June, July. Okay. If you were to buy an ounce of gold, that's gone up 619%. And you're knocking on new all-time highs. Okay, that's pretty clear to me what's going on. Like, let's take a look at the gold. Price of gold, an ounce of gold divided by the SPY. And we'll turn on the logs so this is a little bit easier to understand. So for 1 ounce of gold, what is its relative price to the S&P 500? And you can see I've been tracking it in this very slightly upward sloping channel, upwards nonetheless. You can see we're kind of oscillating, but where'd the rest of my, okay, here we go. Except we need to get this off of 4 hours. We want to look at a macro trend here. In fact, we want it even more macro. We want to look at like a 1 month. Okay. Super big trend changes here we're measuring, okay? You get ahead of your quadratic kernel on the 1 month starting in February 2001, last time you hit this end of the channel. And you went all the way up for the next 10 years to August 2011, eventually falling below it, traveling back down to basically where it's at now. Now, what do you think's going to happen if we get a breakout like this for another 10 years and we go to the other side of the channel? I mean, that would be huge. We'd have to extrapolate way out here. You know, obviously this is a huge amount of time and this is wild, you know, this is just speculation. But say this happens again and this actually truly is a channel here. And we've gone this way, this way, this way. You know, back up here, gold's obviously going to do very, very well. And silver for that matter if this happens. Remember, we're looking at a chart of gold's relative price to the S&P 500, which are large cap United States equities. Basically the big dogs. So if we get a nice clean sort of pattern like this, I'll be ecstatic personally, since I deal with real assets like gold and silver. But these are just things I want you to pay attention to, because there wouldn't be a reason, you know, there wouldn't be a reason of these two things happening in conjunction with each other unless there's some sort of macro trend change potentially occurring. Okay, you can see by this red line here, we have the 200-week moving average. Okay, when you're below your 200-week moving average, you're in a bear market. So let's spell it out for you. From July 93 to September 2001, gold was in a bear market relatively to the S&P 500. Then from October 2001 to December 2012, gold was in a bull market relative to the S&P 500. Okay, then we slipped under again, and we've been in a bear market since. Okay, still technically in that bear market, 3,780 days. I don't even know. I mean, that's 10 years. Okay, potential 10-year trend change, maybe possibly occurring here. Okay, important stuff. You know, if this does this and creeps along and gets above it, well, there we go. So this is super important, but this wouldn't be potentially happening in conjunction with all this other stuff unless there was a very large macroeconomic reason for such things to be occurring. So let's go back to our financial sector stuff if I can find it. Okay, so we're having issues and troubles here in the financial sector. At the same time, we potentially have gold breaking out against the S&P. Okay, that seems like a conjunction of two very important macro things to me. If I can get confirmation on this gold, on gold's relative valuation against the S&P, okay, if I know gold is in a bull market relative to the S&P, I can probably confidently say that the financial sector is in for more trouble, and therefore that would back up my reasoning as to why this triple short is working, or at least has been working if you've been able to make good entries. So anyways, just kind of wanted to relate this financial sector stuff that I've been covering back to some macroeconomic stuff. Let's take a look at silver, because silver is a great investment too, I feel like, if you're going to be getting into things that are physical and not, you know, Ethereum or Bitcoin or, you know, equities. Because like you can own stock, and you do own it. You have ownership rights to it, but it's not like it's something you can hold. Obviously, silver and gold are a little bit different. So you can see silver is above its 200-week moving average. So technically in a bull market against the US dollar. If we look at silver divided by gold, so silver's relative valuation against gold, we're moving above the 200-week moving average, which is bullish for silver, but less bullish for gold. That would mean silver is going to eat some of gold's breakfast, which is great if you stack silver. Let's look at silver's relative valuation to Bitcoin. As you can see, we're still in a bear market, and we don't have much data, but you're certainly knocking on the door here. This is interesting for the Bitcoiners, because if we do something like that, and this green line would represent the price, or the silver to Bitcoin ratio, that would mean that our 200-week does something like this and rounds out. And I'm not saying this is going to happen, but I'm going to speculate and give you ideas so you can make your own opinions. Let's delete this. This would be very interesting if gold or silver broke out against Bitcoin. Obviously, it'd be very interesting if that happened. Okay, let's look at silver divided by the NASDAQ. Ooh, look at that. Moving above the 200-week moving average. Very interesting. Key macro trend change, if so. Okay, last time that happened, December 2001, November, August. Okay, so 2001 was the last time we had a macro trend change like that. And you can see silver moved way up against the NASDAQ. Okay, look, could be happening again. I'm not saying it is, but if it is, that's pretty cool. I mean, it doesn't happen very often. Maybe once every several decades or so. Here's a gold mining stock that I really like. You can see this is Wheaton Precious Metals, WPM. And then we're doing its relative valuation and performance against silver. And as you can see, it's been moving up pretty steadily against silver. if the trend continues, we'll continue to see something along the lines of that when it just gains more money. As silver goes up, wheat and precious metals goes up even more relative to the thing that it's mining. So wheat and precious metals is a silver and gold streamer, which basically means I don't think they own the mines. They do the processing of the ores instead. So they make their money on actually turning the raw, ores of gold and silver into, usable bars or rings or whatever. They're like the middleman in turning the shit in the ground into something actually usable. So they have less overhead costs of mining equipment. Okay, they don't have a bunch of big ass diesel trucks. They just buy the silver and gold off the people that use the trucks to mine the stuff. So I think this is a pretty good equity if you absolutely have to be in equities. So if you're interested in silver and gold at least. And as you can see, wheat and precious metals has been doing pretty good against the SPY lately. Let's look at the silver. Okay, so this is pretty much the same. Silver divided by S&P. Return. So yeah, as you can see, as we go back, it's certainly broken out and failed. We've had breakouts and failures before. But if you can consistently close above this 200-week moving average and the relative valuation to the SPY, I wouldn't be surprised to see it move to the other end of this trend. This line right here. Move up here, maybe take a rest, then bounce back down. Anyways, it's looking good for assets that have intrinsic value, and it's looking bad for things that have earnings and overhead and shareholders and stuff like that. And I didn't realize I was so far away from the mic. I should probably sit up when I'm speaking. All right, how long is this video? 31 minutes. I think that's long enough, guys. I've made my point. Peace out.